Okay, Kieran, we got to start with this video game thing. I was looking at your bio, and I'm just fascinated by the fact that you were once ranked number 2 for some video game I never heard of. You have to give me a break. I'm in my late 40s.
No,
I
you're
don't know
fine.
all the video games.
I think the game
Yeah,
died a lot since I stopped playing it, so
yeah.
it's probably
But
pretty good.
you were number
What
2 in the
game was
world.
it?
Yeah, what game was it?
Yeah, the game was called Smite. It's MOBA, or I think the MOBA stands for Massive Online Battle Arena. It's like League of Legends,
Okay.
but I thought it was more enjoyable. You probably don't know what I just said, but
But you were ranked number 2 in the world, and there was literally like millions, more than 10 million people playing this. Is this correct?
there were 10 million accounts. I don't know, probably in the millions of people that played.
Okay. So now I have a question for you. You've gone on to be a hedge fund manager, and I'm wondering if you're regretting this decision because nowadays I believe that the kids these days are making more money being video game players than they are being hedge fund managers.
Yeah, I sort of left right before that all took off. And you look at the stocks that sort of trade on, like NVIDIA or what is it, Activision or whatever, right? Those all. I think I pretty much me leaving the video game world was like the inflection point. All those stocks and stuff. I like honestly to the month maybe. And so
what I find,
obviously didn't buy any of those. So I ran away from video games as far as that sort of license. And so those went up.
So
like
what
5,
I find,
it was
so what
really
I find
like the
fascinating. Sorry.
No,
Sorry, Kieran. I keep stepping all over you, bud.
Yeah.
So what I find fascinating is the fact that people actually pay money to go watch like an arena and watch people play video games. What is that about? Like explain the phenomenon to me because I don't get it. And after you've done explaining that to me, you can explain electronic dance music where people go and watch somebody press play on their computer.
Oh, I can't explain the EDM part, but I don't do that either. So. Yeah, I mean, it's just like any other game. I mean, why do people watch golf? Why, there's a especially for me as a guy who played games pretty competitively, I enjoyed the skill and watching and trying to understand the thought process and just appreciating the amount of skill that it takes to do these kind of maneuvers and the thought process. And to me, it's just like watching any sport. I still do watch. I don't watch Smite. I watch StarCraft 2. From time to time still.
Okay.
Which I don't even play. I
so,
haven't played that in a decade or something. But I just really enjoy just understanding and appreciating the skill that it takes. Just like I said, any other sport.
Okay, so let's talk some markets now.
Yeah.
Apart from being an unbelievable geopolitical analyst, you're also a little bit of a biotech kind of specialist, or you'll pretend you're not, but you understand more so than Patrick and I for sure. Let's start with that. Why don't you tell us a little bit about your experience there, and maybe we could talk a little biotechs because I think that you might have something that our listeners find interesting.
Right. I mean, let me say, I'm not the expert. My brother is the expert who has been able to develop his own theories that are orthogonal to this current mainstream understanding of biotech. And so we have some pretty unique insight into the whole space simply because we're coming at this from a completely different lens, and we can see value where no one else sees it. And more importantly, we can sort of, we can see sort of how the micro is evolving and how the technology is evolved. And to us, some of the technologies that are coming out of the space are just so fascinating to us. And so, before we were looking at the space, we had no idea. I mean, we didn't start looking at it until early 2017. And then we started digging into it, and there's actually some really, really promising game-changing therapies for a lot of diseases that are not, and I'm not saying they're coming out this year, but they'll come out in the next 5-10 years, and it'll change, chronic kidney disease, heart disease, cancer probably. Cancer is a little bit of a trickier one. Aging is another big one. And, there's sort of been no progress for decades in biotech, and, to sort of just start looking one day and find, a lot of progress or sort of a lot of potential coming down the pipe. It's very, very, promising or fulfilling. I would say, some life affirming. I don't know, sort of like it just feels good to be able to find this sort of level of innovation again that it's going on.
So Kieran, can I ask you? So I pulled up the chart here on the XBI.
Yep.
Now, if an investor was to just buy the basket of using the ETF for the ideas and themes that you're thinking, does that encompass? Is it all encompassed if someone just bought the broader index, or do you have to be far more specific and dig to a couple of individual company names to get these different ideas?
That's a very, very good question. That's a very, very good question, and I can't speak for all the names in the index, obviously, but we sort of, most of our names, our biggest holdings are outside of the standard indices. It's not to say that there isn't a lot of good stuff happening, and you can sort of take advantage. There are other macro trends that you can take advantage of in that index, which that we aren't really necessarily trying to capture. We're much more specific in our approach, but one of the things that really propelled the index this year is sort of all the gene therapy buyouts, and we don't and cancer buyouts, and we don't actually invest in cancer or gene therapy. Simply because we have such a different perspective on how they work that we don't feel comfortable going down that route. But with that said, those have done very well, and they may continue to do well. Overall, you have to think about the trends that are sort of driving the space, and sort of the level of how computers and digitization and big data and algorithms are sort of enhancing how companies go about running drug trials, or sort of understanding how their drugs work, data mining patients, and all those sorts of things really improves the efficiency and our ability to develop drugs, like orders of magnitude, especially since just if you go back to the 90s or even the early 2000s, we just didn't have this level of ability to understand what the drugs are doing and be able to do it quickly and more cheaply. And so that's really a massive tailwind to the entire sector. And then there's also other tailwinds, which is, the whole world's just getting less healthy. And I don't want to bring your viewers down, but, just overall, it's pretty clear that the human population, genetics and health is just deteriorating at a pretty rapid rate. There are a number of reasons behind that, but that should drive demand for biotech, et cetera, especially as the rest of the world sort of gains more wealth as they sort of move up the value chain. They'll be able to afford more drugs. So overall, I think it's a good way. We just, for us specifically, we are just way more specific in what we target, if that helps.
Okay. So, Kieran, I had to look up orthogonal. I'll be honest with you. So it's statistically independent or involving right angles.
Yeah.
I'm not sure which one you're using there, but anyways, either way, you're thinking outside the box, I guess, for us
yeah,
people.
It's sort of a way of not saying everybody's saying. It's a nice way of saying we think everybody's wrong.
Okay. So why don't you tell us what you or maybe try to tell us. In what way are people wrong, or is the market wrong? Because I don't really care about people. I care what the market's pricing. Like, what is the market missing or kind of not appreciating that you guys are appreciating, and where is the opportunity? And, I don't want you to, if you're not comfortable, don't name specific stocks, but, types of technology or anything you can kind of, shed us some insight in terms of what you're thinking and where your thinking is different than the traditional kind of biotech investor.
Right. So on that, I would sort of, it really comes down to a sort of fundamental way in which we think about biology versus how the market, which is just the sum of people's ideas, right? How they think about biology. Really, it's fundamental type stuff. And, we treat biology as a nonlinear complex system. And, that may sound sort of obvious considering it's a biological system, but the way it's sort of treated, the way the market and the way scientists, even in our companies that we go about their therapies and they're treating their therapies, they just don't see it that way for the most part. And that makes it, it makes it very hard at times to sort of invest in companies, even with good drugs, because they won't know how to dose their drug or what therapies to go after some of the time. They're really doing it based on a more, I guess this is getting away from your question a little bit. But, there's just a big fundamental misunderstanding in terms of, what life actually is. And, is it sort of, and that I can't really speak to the philosophical component like my brother does, who has developed all of these theories that we use. But the biggest thing is just sort of the nonlinearity, because we'll invest in companies where the dosing will confuse investors and, what works and what doesn't work, right? If you go too high in a dose, the drug may not work at all. And the same thing is, if you go too low as well, it may not work at all. And there's sort of like a sweet spot in how you want to dose, and that will completely throw off investors, because if they don't see a sort of what they think of as a dose response, where the more you give, the better it should work, right? And then maybe if you give too much, you get toxicity feedback. But they don't see it as an overall, where you get this nonlinear component where you have to, to get the best effects, you have to dose it just right. And so a lot of the times we'll invest in companies with late stage drugs that are super cheap. I mean, we've only been doing this for 2 years, so we haven't had too many phase 3 trials yet, but those are coming finally this year, which is going to be really exciting. And the whole point is, these companies will run phase 2 drugs trials, and they'll show a lot of the time that their drugs don't work non-linearly, and they'll have, only one of the dosages will work really well, and the other will just be flops. And so the market will just focus on, that only works for one of these. So and they don't understand the science enough to be able to say definitively that it'll work. And so because it failed with most of them, they'll sort of just run away afraid, and the company will be devalued. And that's sort of been a sort of frustrating learning curve for us, because learning how the market thinks versus how we think.
Could that just not be a discounting mechanism where they say that if it only works with one dose, that it could be a bad sample, and that therefore there's a probability, a certain probability that it's not an effective drug, and therefore they have to discount that into the price? Like, it could it just be just the way that they discount this?
I think, it obviously is. But, we just sort of disagree. I mean, why are they doing that, though? It's because they don't fundamentally understand or have a better understanding of the actual science. For them, it's a lot of just sort of data mining and sort of seeing what has worked in mice or rats and sort of trying to guess at, what the mechanism of action could be, rather than sort of understanding what it actually is. And, for some of our drugs, we don't actually understand fully what the mechanism of action truly is, because it's so complex and so new, with sort of like epigenetic drugs, which we try not to invest in too much unless there's a lot of data in, even for us. So, I understand the uncertainty, but I'm just saying the uncertainty stems from a lack of understanding and trust in the underlying science, because they just don't know. And they haven't put in the research, they haven't put in the work. And my brother has. I mean, he has had, I think he has over half a dozen autoimmune diseases that he's had to self-treat due to the failure of, modern medicine, essentially. And so in order to treat himself, he's had to learn how biology works, and he's had to be his own guinea pig for a while, and develop his own theories off of existing research. So that's important. It's not like he's in the lab doing experiments or anything. No, there's been a lot of great research that's been done over the last, 50, 60 years. And with the advent of the internet, you can just pull that out and, find interesting data points and, see how that fits into your whole perspective. Sort of like what we do for macro, where we look for signals in the noise, right? And try and put a picture together, right? Except, our picture is constantly moving, right? And his is a lot more static than ours is, right? Does that make sense?
Okay. Yeah, for sure. So let's move on to something that I know gets a lot of headlines, and some of you have been talking about, and you were mentioning that you're a little Tesla'd out.
Oh,
and,
God.
Aren't we all? But
Yeah.
Having said that, I just got to get your opinion of what you think. And
Sure.
recently, there was that great Real Vision piece that kind of I thought very, very, really well presented both sides. And it's just, although I did see that my buddy Jawad, I don't know how to say his last name, but anyways, Jawad said something to the effect that both the bulls and bears are wasting way, way too much time on Tesla. And
Yeah.
I kind of thought, oh, you know what? He's actually probably the most wise of us all. Just don't trade the thing because it's such a battleground. Anyways, I was wondering where you come down and what your thinking is on it.
Well, first off, I think Jawad has been and is completely right on that. Let me just say that right now. And he's warned me to stay away from that stock, and like I said, he was right. And, I mean, where the Tesla story is now, it's in a really interesting spot, obviously. I think the company's in big trouble right now because I'm obviously short the stock. It's a disclosure, I am short, but I use mostly long-dated put options where I'm just betting on bankruptcy. And right now,
You're that much of a bear. You're like out of the money like puts.
Oh, that's by full disclosure. I'm completely in with him. I've got long dated put spreads on the bankruptcy call. So
Do you
I'm
want to get a
in with
room?
you.
Like, do you guys want to get a room?
Yeah,
Both
we're
of you
gonna
just
have
gotta-
to.
right. I mean, and so the whole story right now, I mean, Tesla's going to show year over year or quarter over quarter sales declines. This is after expanding into Europe and China. And then this is after launching the 35,000 which after launching the SR Plus, which is like a $38,000 Model 3, which probably doesn't even exist in the U.S. The point is, though, Tesla is essentially, in order to keep sales from completely collapsing, has to keep tapping into new markets that have pent up sort of stock that they've built up over the last 3 years since they launched the Model 3. And even by doing that, they've had to slash prices by as much as 40% on some of their models. And this has not been enough to prevent a complete collapse in their sales. And so going into Q2, after they've already cut sales, you're going to see, cut prices, in the U.S., you're going to see a further decline in sales of Teslas. And that could be catastrophic in Q2, but, who knows? Maybe they can stretch into Q3. But when you get to Q4, they have a $500 million bond payment, and I don't think they can make that if they tried. They're just going to be burning too much cash, not enough sales, and they're pretty much pissing off all their vendors at this point. And it's run very incompetently, and there's probably elements of fraud. So in the end, I'm just shorting a likely company that's fraud, that's a broken growth story at this point. And given the amount of leverage on the company, and the margin loans on their CEO and all his friends, it's just like a toxic mix. I'm not sure when it's going to go, but, that's why I sort of stopped focusing on it. I mean, I pulled off my naked short just so I don't have to worry about the daily fluctuations anymore. And so I'm just long dated put options at this point, just waiting for it to crash one day.
The one question, because I didn't look into it that much, and I just want to know if either of you two had an opinion on it. But there was that one headline, obviously on the highly credible Zero Hedge, that was something on the in the tune of like it was a huge percentage of their existing cash flows coming from people's deposits, and they're somehow booking that in, which doesn't make sense from an accounting perspective. But I mean, is this just an issue of where they're just gonna be completely cash strapped and it's all coming to roost real time here?
Yeah, and it certainly looks that way. I mean, personally, I couldn't believe when Elon on February 28th announced that they were going to close all their retail stores, because March is their busiest month of the quarter. They sell about 75% of all cars, Model S and X, in Europe in March, and it's about 65% in the U.S. So,
Kieran, why is that? Why is there seasonality? And is that just people buying cars? Am I not aware of that? Like, is that just?
I think most people buy cars in the spring, like the winter, especially Europe has the same kind of climate that I guess not Southern Europe, but I would imagine during the winter you don't go and make big car purchases. You wait till the spring. That's like a natural buying season, wouldn't it?
I think there's some seasonality, and there's also just how Tesla does business, and sort of they always try and make the numbers. And it's not just March; it's the third month of every quarter where Tesla has its biggest sales. And so they'll typically do fleet.
That's when they're
sales.
cooking the books, right?
Come on, that's cynical, Karen. That's cynical, bud.
You just look at their numbers. That's what they do. That's just a fact. I'm just saying they sell the most of their car. Either they discount them or they're selling them in fleets however, obviously you do have the extra seasonality because it's, friggin' cold in, Northern Europe and the U.S. for that matter, right? We've had these sort of polar vortexes that have sort of ravaged the country, right? You guys have been in Canada, right? And my parents live in Winnipeg, so it's been no picnic. I'm sure that no one wants to buy a car then.
Go on. You were talking about Tesla. Something about the fact that that's right.
I was just talking about the store closing right into your best month of the quarter, right? Which just didn't make any sense. Obviously, they walked it back 5 days later when they got a $500 million extension on their asset-backed loan. So that's hinting that cash is probably pretty tight. Elon last year said he has to approve all purchases above $1 million personally. Now he's approving all hiring period across the company. Like the whole thing is just in disarray. I don't know when all the red flags are there. I'm just sort of sitting back with my long-term puts and waiting for the thing to collapse because it is under a lot of stress, just like the CEO is. And obviously he's going before a judge or his lawyers are. I don't think anything bad's going to come out of that. I'm not betting on that. I think the story is as bad as it can be. And obviously, I think interestingly enough, is that how it's traded since the rally off the lows. It's gone straight down, right? It's underperformed the NASDAQ by, I think, over 20% now. And it's really just, not performing well because the story is sort of busted and, all of the big institutions except for Bailey Gifford are exiting the stock right now. And even with record retail buying, the stock's still down. So I think it's in a really good spot, especially considering, the sort of fundamental story where they've run through the entire Model 3 backlog, and they're never going to sell the $35,000 Model 3, especially for a net gain. And to me, it's sort of just a waiting game now. It sort of always has been, but now it's with the story sort of broken, and now you have Lyft and Uber and all these other IPOs coming out, sort of sucking up capital. It's a pretty good time to be short. You can probably wait until it breaks 250 if you really want to be patient. But I believe the fundamental story is strong enough at this point.
So, Kieran, I'm dialing the issue that you're talking about. Are you talking about this $565 million? Let's see which one it is. Isn't this a convertible? Isn't this issue the 1.65s of November 1st, 2019? Is this the one you're talking about? Oh, I see. Okay, right. And it's trading below par. Okay, so there we go. Okay, I got it. So it's a busted convertible because it's like, or not busted, but it's out of the money, so it's just trading like a straight bond at this point.
Right, and speaking about bonds and Tesla's access to capital, I think one of the most I think it's not provable that Tesla cannot physically access the markets anymore, because all they've been able to do recently is access the ABL, the asset-backed lender, which is what you would do in a bankruptcy, right? You would just go to you get a debtor in possession loan from your ABL most likely, which is sort of what's going on. It's sort of like a bankruptcy outside of bankruptcy, right? Where Tesla's like, oh, we're going to close all our stores. Oh, wait, we can't do that. Let's walk that back because we're not bankrupt yet. Right, so let's sell our cars now, and then the whole China loan for the Shanghai Gigafactory was actually that's being paid in installments for whatever, and it's due in a year, and it's all in yuan. So Tesla can't, as we talked about earlier, you can't bring your money outside of China, right? Once it's there,
right.
So that money is designed to build the factory itself. And so the Chinese loan is completely useless for Tesla's liquidity needs overall. And they're obviously the terms are so weird how they're getting it in installments. But beyond that point, really, what's going on is can Tesla raise more capital? If so, how much could they even raise? And if you go back to August 2017 when they had the unsecured bond raise, they were able to raise, I think, $1.8 billion, but it was not oversubscribed. And in fact, once the issue came in, the bonds immediately dipped. And Tesla, said that it was a courtesy yield that they gave the investors. Like, I mean, that's absurd. And this is at the height of the Model 3 rollout. And this is in August 2017. The stock is trading at $380 a share. Why on earth, if your stock's trading at $380 a share, would you not just issue equity, right?
Well, isn't the speculation there that there's an ongoing investigation? And doesn't that require them to file, disclose that? And isn't that the argument of why they didn't do that?
That is definitely the argument. And, so far all actions that Tesla and Elon and everybody involved have made hints that is strongly the case, or something, that there is either an investigation or something is strongly preventing them from accessing the capital markets via, equity raise. Right, and you see that right now with the Maxwell acquisition, where Tesla said in January, "Hey, we're going to buy this, battery company that may have been a fraud." I mean, according to some people, we're going to pay, I think 2.5x for this company in stock, and yet it's 2.5 months later, and the deal still hasn't closed yet, and Tesla keeps extending it because, for whatever reason, they can't issue the shares maybe to pay for the deal. And so that's sort of where, so if they could, why isn't that deal gone through yet? Why is it taking so long? We don't know, right? There's just sort of all of these little hints going on. And
forget about hints. There's more than hints. It's like when they say when there's smoke, there's fire. There's literally a huge plumes of smoke just billowing from this company all the time. The really surprising thing is how long he's managed to keep it in the air if this ends up being like what all the bears suspect. Like, if this ends up being as bad as the bears suspect, this will go down as the greatest kind of promote in the history of promotes. And we're Canadians, and we've seen some pretty great promotes, like Briex and or Vancouver. Like, there's been some great promotes, okay? And if this one ends up being what all these bears think, we're gonna look back and say this was unbelievable, just shocking.
I agree.
And I agree. Going back to, we started the segment off with Jawad, right, saying that it's a big waste of everybody's time, and it has been, right? And what he said earlier this week, that Tesla is just it's a massive venture capital, but it's done in the public markets, right? And so it's part of this massive VC bubble, right? And the VC bubble hasn't burst yet, right? And if you look at other frauds like Enron or Valiant, right? You look at the stock chart of Valiant versus the XBI or the IBB, and it peaked the same day as the market did. The only difference is when the market, had its subsequent failed rallies, there was no rally out of Valiant. It sort of just trended sideways and then collapsed the next time the market collapsed. And
so Kieran, that's Patrick and I have this theory that we're gonna look back, and every great bull has its stock that kind of is the fraud and causes it on the other side. The poster boy, the poster child. And we have the theory that Enron is this bull market.
No, Tesla.
Sorry, Tesla. Have another beer, Kev. So we have this theory that Tesla is going to prove the poster child of this bull market, and it's only when the bull market rolls over that Tesla will really, or either that or Tesla leads the bull market down lower. I'm not sure.
I think it's too small to lead it down, but
I'm not as sure because when
the liquidity disappears, there's no way that Tesla's stock can hold up.
So I completely agree with Kieran that it's being kept aloft by this bull market in venture capital and private equity, and it'll be kind of symptomatic of when the liquidity finally disappears. So it could be that that's the one that's easiest to shoot on the way down, and it will lead, even though it won't be the one that causes the market to go down. It'll be the one that still leads. That's kind of my theory on it.
So it's sort of symbolic, right?
So to kind of keep in the theme of that beautiful unicorn that is at the intro of our Market Huddle session, this idea that they're taking Lyft and all of these other IPOs public, uh, to me, the biggest IPO pushes are almost always done near where market valuations are at their peak and when the liquidity and bulls are the most frothy and you know you can get the most for your issue. And so often when you see a big IPO surge, it's not that far from some sort of key top in a market. Do you think that this Lyft IPO and all these other things are indications that, you know, these investment bankers are taking advantage of this market environment because they don't think it will last?
Yeah, I mean, it's also probably a sign that the private capital markets have sort of just had enough, right? You know, there's for these specific companies, you know, the biggest growth stories are like Uber and Lyft and I mean Pinterest, which is literally pins, right? I think somebody joked that you need a pin to pop a bubble, right? You know, these are all coming due right now because they can't, you know, access capital anymore in the private markets. What's so interesting now, though, is that the public markets are probably more fairly valued than the private markets are. So you're seeing, you know, somehow, you know, these way overvalued companies come to the public markets, and there's this big discrepancy. Normally, it's the other way around, right? For the private market, or it has been in the past, right, where the private is more undervalued than the public because, you know, liquidity issues, right? And then when it comes to the market, then it jumps up a lot, right? But this way, it's kind of, you know, completely, you know, the shoes on the other foot, so to speak. And it's a weird dynamic to trade in, to observe, and I'm not really sure what's going to happen with, you know, you bringing on these overweight, you know, overly expensive companies into a market that's more fairly valued, right? It doesn't seem like a very good mix to me.
So, you know, Kieran, one of the pushbacks I have about that argument, and I've heard that, and I agree with you that it does seem like the private markets are fully priced. Yet Lyft comes to market today in the public market. And, you know, in this day and age, I think that most of these companies, these unicorns, although they haven't traded on an exchange, they've been trading in the private market. And unless I'm mistaken, today's price was higher than any price that it had traded at before. Am I wrong? Like, do you know?
No, I mean, that caught everybody off guard too. I was surprised. I look at Twitter, you know, no one thought this would happen, right? That's kind of the crazy part. Right? Everybody thought, oh, it would go in the 60s, right? But, you know, it opened at 88. Granted, it did trade down throughout the day, right? It hit as high as 88.5, and now it's at 77.7, right? So,
yeah,
you know, there was a pretty big drop. But I mean, like, once again, who predicted that Lyft would open at the top end of the range? So there is this sort of froth still, you know, in the market, which is kind of surprising to me and a lot of other people, it seems like.
Yeah, I agree. And that's kind of my pushback on that idea that the private markets are overpriced. And although I love it because nothing would make me kind of happier than seeing all these guys that are all these big kind of swinging dicks that are buying all these big, huge unicorns, and I would love them to get stuffed by owning all those things at the highs and then trying to come to the public market and not being able to sell it. But that doesn't seem to be the case, and they just that's what worries me, is that this is going to be the same story, in that the public comes and buys Lyft at an even higher price than all the venture capital guys, and they're the ones that end up holding the bag, and that's what I worry about.
I mean, I think it's already happening, right? I mean, somehow Uber is going to be able to price above $100 billion. I think that's pretty much guaranteed at this point. And, you know, Lyft is where it is right now. So those are like the two real big ones. Obviously, I think Palantir is coming down later in the year. There is that sort of feel, right, where everybody's trying to get out right now. And, you know, what if they are? They might be able to. And I think what's so interesting is when I've talked with people like Worth Ray, and they're like, and they can still see these things, and yet they're still bullish. And they're like, well, I think there's still more blood to squeeze out of the stone. Or, you know, if you get if you somehow can get a currency agreement between the U.S. and China, which, you know, Trump and Mnuchin have both talked about, saying there's a strong currency arrangement in their deal. with China, among many other things, I mean, I think then you could see a massive, move to the upside, like we saw it from 85 to 87, where but obviously now the fundamentals are so much weaker. And I mean, I think you on the podcast last week were talking about how this could be a 98 scenario, and I sort of discounted that for a while until you think about if you can get the dollar to drop 10-20% from here. I mean, everything would just surge. These guys and these. I'll stop there. You go. Sorry.
No, I completely agree.
Like, but the difference is in '98, the dollar was rallying, not dropping 10 to 20%. Okay, so
here we go.
No, look.
Patrick's a big bear, so you have to remember that he's bearish. He's going to shit all over.
I'm just pointing out that look. Of course, if there's a 10 to 20% drop in the currency, it is going to be stimulative to the stock market. I will totally agree with it. But in '98 and '99, the dollar rally didn't go down, so that wasn't the stimulus.
Yes, I'm just describing the sort of risk-on mechanism. It was obviously different back then than it is now. Obviously, if the dollar rallied 10-20% from here, we'd all be dead, right?
Well, I don't know about
that. No, I'm
a little bit richer,
Kieran
maybe.
There. No, I'm with Kieran there. The one part that I push against my buddy Brent Johnson's viewpoint is that he thinks that U.S. assets are going to go up, and that's going to mean that U.S. dollar and the U.S. stock market is going to go up at the same time, and they're both going to rip. And I contend that he might be right about one or the other, but he won't be right about both. And I will push back against that. Yeah, I just don't see the scenario where you could get the U.S. dollar ripping for 10 or 20%, and the stock market goes up along with it, and we get a kind of a huge rally. Now, who knows? Maybe I'm wrong, but it just feels to me that's the problem that occurred before. The world couldn't take a stronger dollar, and that is why eventually the Fed had to go on to pause. And for whatever reason, whether it's China or whatever the reason is, that the best kind of rallies occur when the dollar is flat or going down. Like the best rallies in risk assets, because at the end of the day, the America is still the reserve currency, and you need the kind of credit being expanded. And if the credit's being expanded, the dollar goes down. And I think that's in essence why, like if you're bullish on the stock market, you should hope that the U.S. dollar is kind of just drifting lower, because I think that would be the best environment.
Yes, definitely. I agree. 100%. I mean, the world's just different than it was in '98 or earlier. Emerging markets weren't as levered up as they were, especially China, right? Especially to the dollar, right? So you just can't see a dollar move like that. The world has sort of hit peak globalization. S&P earnings, 50% of sales come from abroad, right? So you have all these embedded problems in which the system is so much more interconnected, where, I mean, you just can't see that kind of a shift in the dollar anymore. And it just shows you that the U.S. economy is much more vulnerable to the rest of the world than it once was, right? And that's sort of part of the problem why we have to shift to a different system, because the U.S. is not as strong as it once was, and it can't handle the type of shocks it used to be able to. And that, we're sort of more vulnerable, which makes us more exploitable. That's just sort of a symptom, or sort of a fundamental aspect of the new world that we live in, I guess.
Okay. Well, on that, Kieran, you know what? Patrick and I have to go. We're having a meetup and with some of our listeners at a bar, and so we have to get going because we're going to be late if we keep this up. So
sure.
I just want to.
Yeah.
No, you don't need to apologize. It was
Listen.
great stuff. It was a lot of fun, and I loved it. It was terrific, and I hope our listeners felt the same way, because we really enjoyed having you on, and we're going to have to do it again. So I just want to thank you for coming on.
Great. Thanks for having me, guys. This was a blast.
All right. Thank you very much, Kieran.